Today I want to do a video on the housing market, what it's looking like right now, what I think is likely to happen. So right now, what's happening? At the moment, we are in the middle of a boom. House prices are going up, rents are soaring. At the moment, everything is moving super quick. That being said, over the last couple of weeks or so, I've been beginning to feel the rumors, the tremors of things beginning to slow down a little. I'm not talking like a crash right now, I'm just talking things returning back to a kind of sense of normal, back to what it was like at the start of the year, back in the first quarter. Things are beginning to chill out a little bit. Now, the main reason why the house prices and the market in general has been soaring over the last few months is because we had a quarter when nothing was happening. You know, businesses were shut down, property transactions were shut down. There's like £80 billion worth of property on hold just throughout the coronavirus and the whole lockdown procedure that we had earlier on this year. So that naturally means that when businesses come back, when estate agents come back, when investors come back, everyone's like, look, it's time to make up for the revenue that we've lost throughout quarter two. Let's try and make some money. Let's force our sales. Let's been pushing everything out, force the marketing, all that sort of stuff. And as a result, the economy in general across all sort of sectors is beginning to grow again. The housing market especially has been soaring because we've had the stamp duty holiday, we've had mortgage holidays, we've had the bounce back loans, and now we've got the 95% mortgages coming out as well. It's also coming to the end of the Help to Buy schemes. All those people have been putting their money into Help to Buy, and now going to have to use that before the scheme ends. Now, obviously things are extending and all the rest of it, but the main reason why the housing market has been booming is because of that. Now, I actually did a webinar back in March, and that video is available on the channel if you want to go through it. And I said, look, following this lockdown, this was right at the start. In fact, we shot the webinar on the night that we went into lockdown here in the UK, the back end of March. And I said, look, we're going to experience at least a quarter's worth of just massive growth. Things are going to be flying off the shelves, and we saw that. We saw houses going on the market on Saturday, and by Monday they were sold, and people were getting way over asking price. Buy, refurb, refinance houses, all those houses that need refurbishment, they have been booming. We've been offering on houses as we normally would, and they're going for like 20, 30, 40, 50 grand above what we're offering. This is like a 50 grand terraced house. Like, people just paying way over the odds. Everything has been booming. So what's going to happen next? Well, there's probably going to be like a quarter where not a lot happens, maybe even 2 quarters up to the middle of next year. But there's not a huge amount going on. Things are still going to be moving, there's still going to be positive growth, but it's not going to be absolutely crazy. I would say it's going to look rather normal. Nothing too mad. That's kind of what I'm expecting, that's what I'm planning for. And of course, we've still got Brexit that's due to happen this month, but we'll wait and see as to how all of that goes down, whether or not we get a deal and the way all of that plays out. It's important to note though that our economy is not a isolated economy. The way the UK economy works is it trades with other countries. So you have to be looking at this on a global scale as well as that on a micro scale, what's happening within your individual economy. And back in 2008, the last crash we had, it was caused by something completely different, and it was a global recession. Currencies fell, stocks fell, property prices fell across the world. And I do expect that to happen as well, but we're looking specifically here in the UK. But if you want to know what's going to happen in the UK, you still have to look overseas. So at the moment, obviously, we're going through a US presidential election, which will have an impact on the US economy and hence the economy that we have. But you need to look into what currencies are doing as well. Overseas investment in the UK is a massive driving force behind the strength of the pound and the strength of the UK economy. So if you're going to see the UK economy get sucked, you're probably going to see the UK housing market go with it as a part of that economy. The good news is, back in 2008, the reason we had a crash was because of the housing market itself, and the problem was within the actual housing market, and hence why it was so bad. Right now, I don't think that's likely to be the case. The main reasons why we're going to see a drop are simply because lending is going to get real difficult, inflation is going to go up, and we're going to see the price of living going up, and we're going to start to see a big backlog of all the debt that the UK economy has taken on, the government has taken on to pay for all these things like bounce back loans or the furlough scheme, all the rest of it. They're going to have to get that from somewhere. And the likely place they're going to get it is from increasing taxes. We've already seen that Sunak is planning on raising corporation tax to 24%. I know he wants to raise capital gains tax as well. And of course, the stamp duty is going to come back in. It may even go up. Who knows? So all this is going to happen, which means that you're going to start seeing money flying out of the UK. People are going to want to stop investing. They're going to hold off. There's going to be general uncertainty and things are going to slow down. Me personally, and this is just a prediction, if you're going to put your money into a property, do your own due diligence, make sure you're okay with your own risks, and you've made your own predictions that you can satisfy, you can back up, and you've got the evidence to support that. I personally think that come the end of quarter one, middle, start of quarter two next year, so we're talking like April through to June next year, we're going to begin to see a recession and we're going to begin to see a drop in the housing market. Now, Personally, I think you're going to see somewhere between 12 and 15% drop in London. I think you're going to get somewhere between an 8 and a 10% drop in some of the major cities further south. So I'm talking like Oxford, Cambridge, Milton Keynes, Birmingham, Bath and Bristol, some of those places, maybe even Manchester as well. It's posted a lot of positive growth recently. Some of the areas that have gone up since 2008, places in Cornwall and Kent and around the Midlands or stuff, I think you'll see a drop. It won't be too bad, maybe up to 10%, probably closer to 5%. But most of the towns and cities across the north, especially across the M62 corridor and in the northeast, they just haven't gone up in the last 10 years. Things haven't moved. In Durham, you can still buy terraced houses for 25K, you know, and these are good condition houses, they're not wrecks. So I really cannot see those house prices going down much. There are a few cities and a few towns where the economy seems really, really false. Stoke is one of these places where the house price varies so much from street to street and what is going on, and it's really, really hard to get a really solid idea of what you think the values are going to be. The other problem with Stoke is there's so much investment there. People are buying so many houses. There are so many HMOs lying empty and all this. It's got a false market in terms of how much those houses are actually worth. The values that were driven up weren't actually as a result of Stoke itself expanding or investment in the area. It's just because a lot of investors are beginning to buy houses, convert them into HMOs and build flats and all this other sort of stuff, realised they couldn't fill them and then put them back on the market and other people were coming in to buy them because people like Stoke, because it's cheaper than Birmingham, Wolverhampton, but it's still in the Midlands. I think you're going to see a bit of a drop in places like Stoke and Crewe and other places like Derby and Nottingham. Some of these places have had a little bit of growth, but not loads, and their infrastructure hasn't really gone up. Places like Birmingham, you know, there's a lot of development there in the middle. You've got HS2. I don't think it's going to suffer too badly, but it has gone up a fair bit since the last 2008 recession. So ask yourself, look, if it's gone up loads, there's a lot of room for it to fall back down again. London is always the first place to go down as well as up when you're looking at a recession or a growth curve. Then the further away you are from London, the longer it takes, and usually the less the market will drop by, unless you have a really, really big depression that lasts for many, many years. I do think by the end of 2021, the recession and the drop in the housing prices will be largely over. You'll see a few areas will probably still continue to fall, but come 2022, houses will be back on the rise again, starting with London, and then as you move out further away geographically, the house prices will continue to go up. That could be up to 2 years or even 5 years after this growth period. Maybe it'll be immediate. It really depends on where you are and what you're buying as well. It's really, really important when you're considering capital appreciation and the markets, consider what it is you're buying. A standard 3-bed semi-detached house is the best house for terms of selling, in terms of renting, and in terms of capital growth. Why? Because it's the most common type of house. Terrace houses are pretty good. Detached houses are very, very good. Flats, less so. Flats don't really traditionally go up in value anywhere near as much as houses do. That being said, they're freaking awesome renters, and because of where they are in the middle of the cities, the yields tend to be a hell of a lot better than they do on like-for-like houses or detached houses, semi-detached houses, etc. in the local area. So what does this mean for you? What does it mean for someone who's looking to put their money into property? Well, if you're buying something and holding it and planning on renting it out for cash flow, this shouldn't really concern you. You know, you're not buying a house for the next 2 years, you're buying a house for the next 20, 30, even 40 years. So you need to look at the capital appreciation over the next 40 years, not over the next 12 months. You need to consider that. And in reality, that house will go up in value. The economy will continue to grow. House prices will continue to go up over a 40-year period. Just look back over the last 40 years. Look how much houses cost 40 years ago. So you are going to see some good capital growth there. As long as your house is cash flowing, I don't see any reason why you'd need to sell off. If you're looking to do buy, refurb, refinance and flips, then you certainly need to be paying attention as to when your exit is going to be, either as a refinance or as a sell, to make sure the market is there to support whatever valuation that you're looking to get or whatever sales figure you're looking to get, and in terms of people's appetite towards selling. So obviously you need an area that's even better for selling. So if normally you've got a 2-to-1 ratio of houses sold to houses on the market, and let's say you're okay with that, now you're going to want a 3-to-1 ratio. Because you want to see that there's more houses selling. You want to pick a hotter area that you know you can still sell in when the market is beginning to fall down. Equally, if you're planning on refinancing, especially as an investor, and you're looking at like 80 or even 85% loan to value, just remember that those products, the creative financing, the better options for people like you and me, tend to disappear first when you see a recession. This is already happening. Back in April, they got rid of sub 50K buy-to-let mortgages. You can't buy a house for less than 50 grand now on a buy-to-let mortgage. 50K is the minimum. They also increased the minimum loans. They also increased the minimum loans for HMOs. And now you can buy an HMO for less than 100 grand, but you've got very, very limited lenders as to who you can go to. Above 100K, it's still very, very easy. On top of that, development lending, basically you can write off getting any money towards purchasing your development. They'll still give you the money to refurb it, but your loan to values on purchase have really, really dropped, and the interest rates have stayed where they are, despite the fact the Bank of England have sliced theirs. So when you're looking to get into property right now, and whether or not it's a good time to get into property, I'd always say, look, now is always a good time to get into property. It's always better off to buy something and do a deal and make some profit from that. Even if it's less than you anticipated, then it would be to just wait and make nothing. I'd rather have a percentage of something than 100% of nothing. And if you're buying for cash flow, what does it matter? You're buying for cash flow. The house price is gonna go up, it's gonna go down. It doesn't really matter. You're not factoring in your capital growth gains into your deals, into your profits. Lease options. I see a lot of people doing lease options at the moment, looking at 3 to 5 year terms. If it were me, I wouldn't be taking on anything unless I got a minimum of 7 years. If it's further south, maybe I'll go lower, but if it's further north, I know that for the next 2-3 years, I'm not likely to see any capital growth. So all my capital growth that I'm gonna need in order to buy that house 20-25% below market value at the end of the term, I'm gonna be looking at years 4, 5, 6, and 7 for those capital growth. So if I've got to wait 5 years to buy this house, but I'm going to get 2 years worth of growth out of it, the likelihood is there's not going to be enough margin in that for me to buy it without leaving loads and loads of money in that house. So when you're looking at lease options, always consider the term and consider the area of where you're investing to make sure that when you come to buy at the end, you can buy it and the deal is still a good deal. Just because you're not putting down any money up front doesn't mean that the deal is good. There is such a thing as a bad lease option. And the final thing that I want to leave you with is that 9 out of 10 millionaires are made during a recession. Warren Buffett said, when people are greedy, be fearful. When people are fearful, be greedy. It is the golden rule of being an entrepreneur that when the masses are following down one route, you turn around, you look the other way, and you see the opportunity in front of you in order to make money. So don't be scared just because there's a good chance that the market is going to fall next year, both the general economy and the housing market specifically. Don't be scared about it. Just look for that opportunity, see where you can make money, and there's gonna be so many more properties coming on the market that you can snap up at a really, really good price and will set you up well for the next 10 or 20 years if they're rentals. If you're looking to do a flip, you're probably gonna be able to get even better deals and make even more profit on those deals. So, that is my view of what is going to happen in the housing market. That's what I think is going to happen next year. I want to know what your thoughts are on the recession that's potentially coming on the house prices next year. Comment below on what you think is going to happen, whether you agree or disagree. I'd love to know your thoughts. If you like videos like this and you want to see more like them, please hit the subscribe button here. And I can't wait to see you next time.